The world of investing can feel like this huge, overwhelming place, right? So many opinions, complex strategies. It's a lot.
Definitely.
But what if there was a way to kind of cut through all that noise, to find an approach that really clicks for you?
Hmm.
Well, today we're doing a deep dive into investment philosophies. We'll guide you from the elegantly simple stuff right through to the really complex ideas.
Yeah, and our mission here is to pull out the key insights from the sources you've shared with us. It's not just about what these philosophies are, but, why they might matter for your own financial path.
That's crucial.
Because honestly, there's no single best way. It's really all about finding what fits your goals, your comfort level with risk.
Okay, so let's start unpacking that. Maybe begin with the foundation, the real bedrock of long-term wealth building, patient, passive strategies.
Good place to start.
Let's talk buy and hold. I mean, it sounds simple, but the power of just staying invested, even when the market tanks, and just keep adding money, it's actually pretty surprising.
It really is.
Yeah, like we saw this example. Someone putting in just $500 a month, consistently, starting back in March 2000. By 2025, they'd be nearly $200,000 ahead of someone who, got scared and paused during just 4 big downturns.
Wow. That's a massive difference.
It is. But for a lot of people, knowing you should stay invested and actually doing it when panic sets in, those are two different things. What's the behavioral trick here?
That's exactly it. The biggest danger often isn't the market dropping, it's our own reaction, right? Fear, panic selling, turning those temporary on-paper losses into actual permanent ones.
Right.
And this is precisely where something like dollar cost averaging or DCA fits in. It's almost less about financial genius and more about managing our own psychology.
How so?
Well, it takes the stress of when should I buy out of the equation. You just invest a set amount regularly, automatically. It smooths out the ride.
Okay, so DCA helps you stick with it. If you're embracing that long-term patience, well, it's a practical, kind of easy way to get your money in the market without trying to be a stock-picking genius.
That leads us perfectly into index and ETF investing, exchange-traded funds, ETFs.
Right.
The main idea here is super powerful. You get instant, broad diversification. You basically own a tiny slice of the whole market or a big chunk of it.
Instantly diversified.
Exactly.
Yeah.
And usually with really low costs and pretty good tax efficiency too, you're essentially being the market.
So simple is powerful here.
Absolutely. I mean, the sources suggested you could build a solid global portfolio with just 2 ETFs, maybe one for global stocks, one for bonds. Keep it really simple.
Okay, so you've got that passive core, that foundation set up, but some investors, they want to be a bit more hands-on.
Yeah.
Actively look for opportunities.
Right. Moving beyond passive.
That brings us into active selection. Let's start with a real classic, value investing.
Value. Benjamin Graham, Warren Buffett, titans of investing.
What's the core idea? Just buying cheap stuff?
Well, yes and no. Graham started with finding cigar butt stocks, cheap, maybe unloved companies with one last puff of value. But Buffett really refined it, didn't he? Looking for wonderful companies at a fair price. So quality matters. It's about identifying businesses with a durable economic moat, something protecting their profits that the market just isn't appreciating right now.
Like finding hidden gems?
Sort of, yeah. Finding quality that's temporarily on sale.
Okay. And what about the other side of that coin? Not looking for bargains, but betting on, say, innovation, big growth.
That's growth investing. Think Peter Lynch and his idea of GARP growth at a reasonable price.
GARP, okay.
Yeah, you're looking for companies growing faster than average, boosting their earnings, but you don't want to overpay wildly for that growth. Lynch famously said, invest in what you know, but critically, always do the homework. The analysis has to back it up.
So value and growth, different angles, same goal.
Pretty much. Both aim for your investment to appreciate, to grow in value, just different places they look for it. Value often comes with dividends too, which is interesting.
Dividends. Tell me more.
Those are basically your share of the company's profits, paid out regularly. And get this, over like 90 years, reinvested dividends made up roughly 40% of the S&P 500's total return. It's huge.
Wow, nearly half. Okay. Now, what if someone wants their money to do more than just grow? What if they wanted to align with their personal values?
Absolutely. That's where socially responsible investing, or SRI and ESG, come in. Environmental, social, and governance factors.
ESG. Seeing that acronym more and more.
Yeah, it's about integrating these non-financial factors into your investment analysis. Does the company treat the environment well? Its employees? Is it governed ethically?
And does it mean sacrificing returns?
Well, the research largely suggests No. Often there's no financial trade-off, and sometimes you even get lower downside risk. The one thing to watch out for is greenwashing.
Meaning,
Companies kind of exaggerating their ethical or environmental creds. You still need to look under the hood.
right, due diligence is always key. Okay, so we've covered passive value, growth, ESG. Are there other, maybe more specialized areas we should touch on, even briefly?
Definitely. You get into things like factor investing, targeting specific characteristics like company size or momentum. Then there's algorithmic trading, mostly big institutions using speed and tech. Global macro hedge funds making big bets on economic trends. And arbitrage, trying to profit from tiny, fleeting price differences.
And complex.
They tend to be, yeah. And then at the very far end of the risk spectrum, you have things like options and futures, highly leveraged.
And probably not for building long-term wealth, right?
Generally, no. These are complex tools. We saw figures suggesting like 90% of retail options traders lose money, leverage cuts both ways, and time decay works against you. These are really for sophisticated, experienced traders, not your core retirement savings.
That's a really important distinction. So after covering this whole spectrum, from simple buy and hold to complex options, what's the takeaway for you, the listener?
It brings us back to the start, really. The best approach. It's deeply personal. It depends on your goals, how much risk you can stomach, and honestly, maybe most importantly, your own psychology. What can you stick with? So, maybe a mix.
Could be. A popular idea is the core satellite approach. You have a solid core of low-cost index funds, like we discussed, and then maybe smaller satellite investments in active strategies or themes that genuinely interest you and you understand well.
Right. At the end of the day, the best philosophy is the one you actually understand, you believe in, and importantly, the one you can stick with through market ups and downs.
Exactly. Consistency is key. So we've journeyed from simple patience to complex algorithms. Here's a final thought to leave you with. As you think about your own path, look around your own life, your job, your hobbies. Are there unique insights you have, opportunities you see that could shape your personal definition of value or growth? Something beyond what the standard Wall Street analysis might ever capture.